So let's begin. Chapter 5, Bonds. So we've already covered bonds. Well, not really cover. We introduced the concept of bonds. I think in chapter 2, where we said bonds are a debt instrument. They are IOUs, well, which means I owe you. I have to pay you. You gave me money, so I have to give you back that money. It's a loan. A more formal definition of a bond would be a debt instrument whereby an investor lends money to an entity, and that entity can be a company or it can be a government who is borrowing the funds for a defined period of time at a defined fixed interest rate. Which isn't completely right, but since this is an introductory qualification, we say it's a fixed interest rate. There are some bonds which have a variable interest rate, like we covered previously. But for the sake of this exam, let's just stick to what's in the book. It's fixed interest rate, which is referred to as a coupon. Also here it says there is a defined period of time. Most bonds have a defined period of time. They have a defined redemption date, but not all of them. There are perpetual bonds which go on forever. But then again, this is a introductory qualification. Clearly, the reason for issuing bonds is for the issuer to raise finance, to get capital. And that's why when we are looking at, or we are defining capital, we said capital is both equity and debt, perhaps to fund something in particular as shown in the example below. So let's look at the example. Crazy Jet, don't ask me where CISI gets the names of their examples, but Crazy Jet is a small airline that has been successful to date, and they want to expand their fleet of aircraft. Obviously, coronavirus hasn't affected them yet. Needing to raise the necessary cash from somewhere, Crazy Jet considers borrowing the money from a bank and is quoted an interest rate of 8% for the 5-year loan. Instead, they think that 8% is a very high price and they don't want to go down the equity road because they don't want to give up any ownership in their company. So they still want to borrow, but they don't want to pay 8% on the debt. Instead, they decide to issue 1,000 bonds, each for $1,000. So they are looking to raise $1 million in order to raise the finance to buy more aircraft. Crazy Jet will pay only 5% interest on the bonds. Now here, Crazy Jet is taking a risk because they are offering less interest. Well, they are benefiting themselves because they are going to be paying less interest than the bank is charging. But will there be demand for their bonds? Mr. Will Lend has $1,000 to invest. He has traveled on Crazy Jet before and he really enjoyed the experience. So he decides to buy a bond paying $1,000 and receives the following. So he said, okay, fine, I will pay the $1,000 and he receives this. This is what he's going to receive. A paper or an instrument that says, I owe you, which means Crazy Jet owes the holder of this paper $1,000 because Mr. Will Lend bought one bond for $1,000. Crazy Jet owes him $1,000. The above sum will be repaid in 5 years' time on June 30th. From now until then, 5% of the above sum of the $1,000 will be paid each year on 30 June, up to and including the date of repayment. And this was issued by Crazy Jet. Now notice here, CrazyJet says that they will pay 5% of $1,000, the coupon, each year on 30 June. By default, in CISI exams, if you're going to take more CISI exams in the future, by default, coupon is paid twice a year. So by default, this is actually going to be 2.5% for the first 6 months and 2.5% for the second 6 months. Keep that in mind once you get into other CISI qualifications. But since we're only introducing the concept of bonds, we're going to just say it's 5% per annum paid on 30th June. So this is an IOU document, a debt instrument. A bond is an example of that. As shown in the above example, the issuer of the bonds, CrazyJet, chose to issue bonds in preference to other potential forms of finance, equity or banks. The bonds were actually cheaper because they cost CrazyJet 5% in interest than the bank loan that was available at 8% in interest. That's why bonds, usually for many companies, they are the way to go. Of course, not for all companies, because usually bonds are issued by listed companies and by governments. They can be issued by unlisted companies, but that's a different protocol. So here is an example of an actual bond issue made by Microsoft in August 2016. Of course, everybody knows Microsoft. They sold or they issued $19.75 billion of corporate bonds in August 2016. They decided to sell 7 individual groups, or what we call tranches. Again, not in this qualification. Tranches is something that you learn in other CISI qualification. Tranches of bonds repaying the money at different dates and paying different interest rates. So that 19.75 billion, the first tranche was 2.5 billion to be repaid or redeemed in 3 years' time, and it's going to pay 1.1% interest per annum. The second tranche was for this amount for 5 years. Obviously, because it's for a longer period of time, Microsoft was paying more interest. And until the 6th tranche or the 7th tranche, 2.25 billion for 40 years, and it carries an interest payment of 3.95. Very rarely would you see, usually bonds are issued for between 1 to 15 years, 1 to 10 years mostly. But in some cases, you do find bonds for over 10 years, both on the corporate and the government side. Microsoft was unspecific about how the money raised will be used, although some of the proceeds were probably used to fund the previously announced acquisition of LinkedIn, which they bought for $26 billion in cash. So there was no exchange of stocks. They bought LinkedIn for $26 billion in cash. And they used part of that money, part of the money they raised in the bond issue, they used it to finance their acquisition of LinkedIn. So why were they different interest rates on the bonds? The different interest rates payable on the 7 bonds were driven by the returns demanded by the investors for the bonds with different repayment dates. So what this is saying is that short-term bonds have higher demands. So because there is higher demand, Microsoft wouldn't be willing to pay high interest rates because they know investors are going to buy them anyways. Whereas the longer term bonds have less demand. So in order to encourage and entice and motivate investors to buy them, they were willing to pay triple the interest rate. The fact that the required interest payment increases as the time to repayment increases is a function of risk and reward, because the longer you are going to take to pay back the investor, the more you should pay him. Longer date bonds are more risky, and hence the investors want greater returns. And if you take other CISI qualification, you will learn something called the modified duration or the Macaulay duration. The word duration here in bonds doesn't mean the length of the period of the bond. No, duration in bonds means risk. So the longer the date of the bond, the higher the risk, and thereby the higher the expected return. Microsoft is more likely to have problems over the next 40 years than over the next 3 years. As the above example shows, companies can choose to issue bonds with different dates of repayment, or different maturity dates, or different redemption dates. The repayment dates chosen will depend on a number of factors, including the financial plans of the company and the periods over which the investors may wish to invest. So many things go into consideration before an issuance is made, especially for the issuance of a bond. A significant number of developed countries' governments, like the US, the UK, and Europe, they issue bonds, and they often spend more in a given year than they receive in taxes. So that gap, that deficit, is financed with borrowing. Major countries like the US, Germany, France, and the UK are all significant issuers of government bonds. And these bonds are known to be very safe and risk-free because these governments always pay back their debt. To provide some insight into the reasons governments might want to reborrow, the following example outlines the US federal budget for the year 30 September 2019. So you get to see how the US government borrows. The federal budget, of course, federal budget is for the whole country. You had the municipal budget, which is for the town, and then you've got the district budget for the district, and then you've got the state budget for all of state, and then you've got the federal budget for all of the United States. So the federal budget is the expected income and expenditure of the US for the period, and it shows expenditure exceeds income. Now, the last time the US government income exceeded the expenditure, thereby having a surplus, was, I believe, during the time of President Clinton in the 90s. But since Bush II took over in the year 2000, ever since then, the US government has been in deficit. Expenditure has exceeded income. And that was very much true in the 2008 financial crisis when they had to bail out many companies, and it went more into debt, into deficit following the coronavirus outbreak. This deficit needs to be funded in some way, and it increases the US national debt. So let's see what the federal budget for 2019 was. The total expected receipts, usually from taxes, were 3.4 trillion. The total expenditure was for 4.4 trillion. Thereby, you got around 1 trillion in deficit. The difference is the expected spending is almost 1 trillion, more than the receipts. This difference will need to be funded through the issue of US Treasury bonds. Now, all bonds tend to exhibit certain key features. We're not saying that all bonds are the same. No, they do have some similar features, particularly a date when the bond will repay the money loaned and the frequency at which the interest will be made. We said most bonds have a maturity date, although some bonds don't. Keep that in mind for other qualifications. The frequency at which the interest is being made, we said usually the interest is paid every 6 months. Some bonds do pay interest once a year. Returning to our earlier example of crazy jet bonds, both of these features are clearly displayed. So the first feature, which is the date at which the bond will be repaid, which is 30 June in 5 years, and the frequency, which is 5% will be paid each year at 30 June. The repayment date is in 5 years, and the interest payments are paid annually on 30 June. Each interest payment will be made at 5% of $1,000, $50. Some bonds pay interest more frequently, perhaps semi-annually rather than annually, and this is the default for many bonds. If the Crazy Jet bond paid interest semi-annually, then it would split the annual $50 into two $25 payments, perhaps one on 31 December and the other on 30 June. Bonds are tradable instrument, so if you buy that bond from Crazy Jet and you cannot wait for 5 years to get paid, you can sell that bond. There are investors in the market who are willing to buy it from you. This means they can be bought and sold. To see why this feature might be important, let's revisit Mr. Will Lend, who purchased Crazy Jet bond in the earlier example. So in that example, we will recall that Mr. Will Lend bought that bond and that will repay him the $1,000 that he invested in 5 years. And during that period, he will get a 5% interest. So 3 years have elapsed, and Will has money problems himself. So he needs the $1,000 he invested. He cannot wait for 2 more years. He wants the money back now. He's trying to get together enough cash to buy a car and could really benefit from an additional $1,000. The answer may lie with the Crazy Jet bond. The bonds can be traded, so Will can offer the bond for sale. Hopefully, he will get the $1,000 that he hoped that he paid for, but he is not guaranteed to get the $1,000 that he paid for. However, he will obviously miss out on more interest payments because if he sells it now, there are 2 more years of interest payment that he will not get. These will be paid to the new owner of the bond, and the new owner of the bond will take that into consideration. The factors that will impact whether Will get $1,000 include whether Crazy Jet is still successful, so there is demand on their bonds, so it's possible that the bond will be bought or will sell it for more than $1,000, and whether the 5% coupon that is available on the bond is still competitive compared to other interest payable on the banks. So if banks are currently paying on deposits more than 5%, Will is gonna struggle selling that bond because borrowers will say, lenders would say, wait, why should I buy this bond from you and earn 5% every year when I can put this $1,000 in the bank and then earn on it more than 5%, which is a very sensible question. And that's why there are many different types of bonds. You'll see them trading probably at 998. There isn't much demand, and you might find them trading at a higher price. Now, bonds are usually traded at multiples of 100. So you might actually find them at 99.8, or you might find it at, let's say, 102.0. Moving on. Well, before we go into that point, let's just tell you something quickly. Bonds, no matter what price they are currently being traded at, the closer they get to their maturity date, remember, bonds have a maturity date. The closer they get to maturity date, the closer they will get to $100, which is their nominal value. So no matter at what price you buy it, you know until 30 June in 5 years, let's say 30 June 2025, the price on that day will become $100. It will revert to its nominal. Bond terminology. Like finance generally, there are a number of terms that are used for bonds which need to be understood. Jargon, words that we in finance use to scare people who are not in finance. The nominal value of a bond is the amount that is owed by the bond issuer, and that will be repaid on the repayment date. In our previous example, that's $1,000. This nominal value is sometimes called the par value or the face value, because the amount that is written on the face of the bond, or the certificate, the IOU. If you remember from the document that we saw, it says that CrazyJet will pay $1,000 on 30 June in 5 years' time. In the meantime, they will pay 5% on that $1,000 every year. The date on which the bond is going to be repaid is called the redemption date, sometimes called the maturity date. So sometimes you hear people say bonds redeeming in perhaps 5 years' time or maturing in 5 years' time. The interest rate that is applied to the nominal value of the bond is typically called the coupon. Because a long time ago, these bonds used to be papers and they used to be perforated. That means they can be torn. So you will just take the paper. At the end of every year, you will tear this first part, and then you will go to the bank, you will give them that part, and then the bank will give you your coupon. And then in the next year, you will tear it, and then go to the bank, give them that paper, that torn paper, and then they will give you your coupon. That's why we say clip the coupon. But of course, now it's all electronic, so they don't actually do it physically anymore. So returning to our earlier example of the CrazyJet bond, we can see that the nominal face value is $1,000. The maturity is in 5 years' time. So if it's 30 June 2020 when it was issued, the maturity is going to be on 30 June 2025. 5% is paid annually on the $1,000. So now if this bond is being traded, and the market price is 1,100, or let's say 1,200, you are not going to earn 5% on 1,200. No. You will not get that. Also, on maturity, the issuer will not give you 1,200 back. They will only give you $1,000 back. So they don't care that you actually bought it at 1,200. So on maturity, they will take it back from you and give you only 1,000. Also, they don't care that you bought it at 1,200. So they will not pay you 5% on 1,200. No. They will only pay you 5% on $1,000. Interest is only calculated on the nominal value. And redemption is only made on the nominal value. The issuer doesn't care what price you bought it from. Now, some investors, they say, fine, I'd buy it. Let's say if the nominal is 1,000, I would buy it for, let's say, 1,010. So this is the market price which the investor is willing to pay. But the investors know if he pays 1,010, in a few years' time, he will have to return that bond and get 1,000 in return. So he will actually suffer a loss of 1,000. And we call that a capital loss. But that's fine, because during that period of time, which is, let's say, 2 years, he's going to earn 5% interest every year, which is $50. He will earn $50 in the first year. He will earn $50 in the second year. So he will earn $100 in total from interest. He will lose from his capital at the end $10. All in all, he's going to be making $90. And that's fine. That's why some investors are fine buying a bond above its nominal price, even though they will suffer a capital loss at the end. That's because they realize that they will earn enough interest or enough coupon to cover that capital loss at maturity. Or they can sell the bond before maturity. Either ways, it works fine for them. Bond yields. We now want to learn, or we need to learn how to calculate the yield, otherwise known as the return. The final piece of terminology to consider in relation to bonds is the yield. The yield actually is the very basis, the very fundamental concept when investing and trading in bonds. We don't go into much details about yields in this qualification. They just scratch the surface about what is yield, how it's quickly calculated. But in other CISI qualification and in your career, if you are into trading of bonds, the yields and the yield curve is the bread and butter of investing in bonds. Yield is another term for return. It's expressed as a percentage, an annual percentage. For bonds, it is tempting to think that the return, or the yield, is the same as the coupon. So, if you buy a bond with $1,000 of nominal and it pays a 5% as coupon, then 5% is your return. Technically, no. This is only the case if $1,000 is the nominal and $1,000 is the price that you paid to invest. But sometimes you might buy the bond at a different price. So if you know that you are going to be receiving $50 every year in coupon, and in order to buy that bond, you need to invest $1,200, what will your yield be? The yield will be what you receive every year over what you have invested, and this should probably give you 4 point something percent. Let's just do it quickly. So 4.2%. So for every $1,200 you invest, you are going to get a return of 4.16% in the form of $50. This is yield. Calculate the yield. You divide the annual coupon over the price paid. Now this is what we call the annual yield, sometimes called the flat yield, sometimes called the running yield. You will learn more about these in other CISI qualifications. If interest rates generally increase after a bond issue, then to sell the bond, the yield will have to increase to attract the buyer. Why? Because the buyer has an option of either putting his money in a bank account and getting higher interest rates, or buying that bond and getting a certain return. So if you want to encourage the buyer to buy the bond instead of putting the money in the bank, that bond should give the buyer a higher yield. The only way this can happen is by reducing the price, because yield equals to coupon over price. Coupon is fixed. So if you want to do any changes to the yield, you will have to make a change to price. Now, since this is a fraction, of course, if we go back to high school, x equals to y over z, the relationship between x and z is an opposite relationship. So every time z goes down, x goes up. So if I want the yield to go up to encourage this investor to buy this bond, the price needs to drop. The only way this can happen is by reducing the price. In the Crazy Jet example, the coupon payment does not change because it's $50 per month, per year, and it's a fixed interest payment. Keep in mind, some bonds have variable interest. Now, since the coupon is fixed, the price fall means that the coupon, which we are receiving $50, is bigger percentage of the amount paid. So, at price point A, my yield was $50 coupon over, let's say, $1,200. So my yield was 4.2%. Now let's assume that the price changed, the price dropped. What will the yield be? The yield will become $50 over, what's the new price? Let's say $800. Sorry. So the yield becomes 6.25%. You see how the yield increased from 4.2 to 6.2? It increased because the price dropped from 1,200 to 800. And of course, the opposite is true. So why would the price of the bond drop? Because interest rates have gone up. Why did it drop because of interest rate? Because people no longer want the bond, and they will put their money in the bank and earn a higher interest. So when that happens, demand for that bond decreases. And when demand decreases, nobody wants to buy a certain product, its price will drop. The opposite is true if interest rates fall. If interest rates fall, banks will give you lesser money on your deposits. Investors will all rush to buy bonds because bonds give you higher interest. And when everybody rushes to buy bonds, an increase in demand will cause an increase in price. And when the price goes up, the yield will drop. Buyers of the bond would be willing to accept a lower yield, and the price of the bond would increase. Note that if the buyer keeps the bond until maturity, the bond yield will also be supplemented by the fact that the buyer will make a gain when the bond matures and pays $1,000 because they only paid $800 for it. So if you buy a bond below its nominal value, so nominal value here is $1,000, in CISI exams it's either $1,000 or $100. And if you pay $800 for it, there will come a time when the issuer will take that bond from you, which cost you $800, and give you back $1,000. So they will give you back more than what you paid. So you will make a $200 capital gain for it. An investor who is lucky to have that will earn, in addition to the annual interest coupon, which they are earning, the income return, they will also be making a $200 capital gain at the end. So that bond would give you both returns. It happens that you get both returns from bonds. When the yield calculation includes only the calculation of coupon divided by price, it's called a flat yield. Why? Because I only looked at the coupon over price. When the calculation includes the capital gain until maturity, it's called the yield to maturity. CISI prefers to call this the gross redemption yield. The redemption yield. So what's the difference between the redemption yield or the yield to maturity? The redemption yield and the flat yield? The flat yield, which is the annual yield or the running yield, which we calculated in the previous page, the flat yield only looks at coupon over price, whereas the redemption yield considers coupon and any profit or loss you make at the end. I will give you an example now on the calculation. Although the calculation doesn't come in the exam, you only need to know the difference between them. We will show you a calculation, how it's done, and you can see the difference between them. In summary, there is an inverse relationship between yield and bond prices. If required yields increase, the bond prices will decrease. If required yields decrease, the bond price will increase. This relationship can be thought of as a seesaw. Now, let's look at a quick example of how this might work out. So let's say an investor buys a bond, and the bond details are as follows. The nominal value of the bond is $100. The market price, which is the price that he actually paid to buy it, is 103. Maturity of the bond is in 3 years, and the coupon is 5%. Now, let's calculate two things. What is the flat yield, the annual yield, or the running yield? And what is the redemption yield, or the yield to maturity? So the flat yield is very simple. This is the coupon over the price. So the coupon over the price, the coupon is 5% of nominal 100, so that's $5. The price that he bought it at was 103. This gives our investor a yield 5 over 103, an annual yield or a flat yield or a running yield of 4.85%. So assuming that this investor decides to keep the bond with him until maturity, he knows that in 3 years' time, when the bond matures, he will have to return it to the issuer. He paid for it 103. He has to return it to the issuer, and the issuer will give him 100 for something that cost him 103. That means on maturity, this investor is going to lose $3 on redemption. We call that the capital loss. Now, if somebody is asking this investor, well, knowing that you are going to be losing $3 at maturity, how much are you actually making out of this bond on an annual basis? So the investor would say, well, if I am going to lose $3 at maturity, and the bond is going to mature in 3 years, so technically I'm losing $1 per year. Because my total loss will be 3 years for the duration of my investment, and the duration of my investment is 3 years, so $3 losses across 3 years means a $1 loss per year. So if you're actually going to calculate the gross yield, the total yield, the gross redemption yield, you will consider this $5 as coupon. You will also consider, which is an annual payment, you will also consider this loss that you are making. You are going to be making $1 loss every year for the next 3 years. So what is my actual return considering both the income and the capital loss? Well, the income is $5 minus the capital loss, $1. So technically, I am getting $4 every year out of 103. And if we do this calculation, we should get 3 point something. So it's 3.8%. And this is the redemption yield, which is what the British use, or the yield to maturity, what the Americans use. Same thing. So you'll notice that your redemption yield is 3.8, but your flat yield is 4.8. So why is your redemption yield lower? Because your redemption yield considers this loss that you're going to make at maturity. Again, all of this does not come in the exam. All of these calculations do not come in the exam. You only need to know the difference between the redemption yield or the yield to maturity and the flat yield. And that's it. Advantages and disadvantages of investing in bonds. Like almost all investments, they always have a good side and a bad side. Now, the features and characteristics of bonds have been encountered. The advantages and disadvantages of investing in bonds can be considered. Two particular features provide the key advantages of investing in bonds: the coupon annual interest, and a redemption date, which is when you're going to get back your investment. Remember, with equity, with stocks, they don't pay you back for your shares. Unless you decide to sell it in the market, yes, you get your money back. But there is no guaranteed redemption date with shares. For investors, a predictable income is seen as an advantage, and most bonds pay a stated amount of income every year or half year in the form of coupons. Some investors are income investors. They want dividends from stocks, they want coupon from bonds, they want rent from property. They live off the income. This is in stark, that means major, contrast to equities, where the amount of the dividend can be unpredictable as the companies have profitable or unprofitable years. Similarly, it is seen as a positive feature that bonds will repay a set amount of cash at an agreed date in the future. You can manage your liability. We call that immunization, something you will learn in Level 3 Wealth and Investment Management qualification. Immunization is when you protect yourself from a future liability. You know you have to pay for college fees or you have to pay for any liability in the future. You can invest in bonds now and invest in bonds that will redeem during that period that you have to cover your liabilities. This way, the bonds will cover your liabilities. Bonds are an excellent way for investors to match their liabilities and their cash. The investors know when investing how much and when the redemption will occur. It's pretty clear from the terms and the conditions. This again contrasts with equities, where the price at which the shares can be sold is unknown. Share price go up and down. The potential disadvantage of investing in bonds is the possibility that the issuer will fail to pay some or all of the coupons at the redemption amount because it doesn't have available funds, and we call that default risk, or we call that credit risk. So they call that credit, sometimes issuer, sometimes default risk. In such circumstances, the issuer is described as being in default. Less substantial issuers are more likely to default than others. Than other more substantial issuers. Substantial means bigger and stronger. Of course, the bigger and the stronger the company or the government, the more likely that it will pay. Smaller companies, smaller governments are more likely to default. However, rather than a complete default, just an increased possibility of default can have an adverse impact on the return for an investor. So just the perception of the possibility of default can cause many changes to the bond's price and to the investor's return. This would be the case if the investor has to sell the bond before it reaches maturity. Let's look at an example. Carlton Barat is a musician who has fallen on hard times. Don't they all? Fortunately, when he was earning substantial money, he purchased $1,000 face value 15-year bond paying 6% annual coupon. And he bought it from Worldwide Resources. The bond's maturity is still 7 years away, but Carlton really needs cash now. He decides that selling the bond is a sensible thing to do. Interest rates remain the same as when he purchased the bond. However, Worldwide Resources has itself not performed well, and there is an increased risk that it will default on its bonds. Because of this increase in risk, investors are now looking for an increased return and a yield of nearer 14% on Worldwide Resources bond. This has meant that the resale value of Carlton's bond is now $6,500 because investors expect a higher yield, price needs to drop, and there is also a lower demand. So even though he invested $10,000 in this bond, the current value of the bond in the market is $6,500. This example illustrates what happens when a bond is sold before maturity, and the risk that the issuer will default has increased. This is alternatively described as an increase in the credit risk of the issuer. the risk that the amount owing the credit might not be repaid. Sometimes called issuer risk, sometimes called default risk. Here is a summary of the key advantages of investing in bonds. Predictable income in the form of regular fixed coupon. I mean, the only thing that can compete with bonds on this is bank accounts give you regular fixed interest. Not even rent is guaranteed because sometimes your tenants might not pay. The other advantage of investing in bonds is that there is a fixed date. You know when you're going to get your money back, and the amount that's going to be repaid, which is the nominal that has been already identified and confirmed in the terms and the conditions. But investing in bonds also has disadvantages. There might be a default from the issuer. He's not able to pay for the coupons or redemption. An increased risk of default resulting in the fall of a bond's value. And there are many other risks that influence bonds. There can be currency risks. If you buy a bond in a different currency and you try to exchange it to your home currency, you might lose on the exchange. There's interest rate risk. We've seen when interest rates go up, the prices of the bonds will go down. There is inflation risk. Because bonds pay a fixed amount of coupon every year and inflation influences the value of money, the value of this coupon in real time, in today's time, goes down year by year. Inflation is a big problem for bond investors. So, how do you know if a bond is of high quality or not? How can you rate it? Well, you don't need to do it yourself. You can just look at the ratings from credit rating agencies. Credit rating agencies are companies that study issuers of bonds and their bonds. And then they decide whether the issuer or the bond is a high rating, that means it's a very safe bond, it's very likely to be paid back, or a bond is low rating, that means there is a risk the issuer might not pay back. And the rating agencies usually give these bonds ratings like AAA, which is excellent, or C, which is terrible. We have just seen what happens when the credit risk of the issuer of a bond increases. When the credit risk increases, the investors get nervous and they demand higher returns. They get nervous whether the coupons will continue to be paid and whether the repayment will happen at maturity. The combination of these two factors means that any new investors are not willing to pay as much for the bond as previously because it's just not worth it. As what happened with Worldwide Resources bonds, the result is that the bond's price will fall. Assessing the credit risk for particular bond issues and monitoring any changes is not just done by the existing and potential investors. There is a small number of specialist firms, and these are what we call credit rating agencies, that look at bond issuers and assess the credit risk. There are three dominant ones globally: Moody's, Standard & Poor's, or S&P, and Fitch Ratings. Technically, I think there are 72 credit rating agencies around the world, but these three are the biggest ones and the most famous. So, all three credit rating agencies adopt similar methods for assessing risk. So you will notice here, you look at the letters that they give. S&P and Fitch, they provide capital letters. Moody's provides capital small letters. So they all use an alphabetic system where the safest issuers with least credit risk are termed AAA. And it's very, very rare to be AAA. You have to be incredibly safe. I mean, not even the biggest and the safest companies are AAA. I think AA is the max that you can get for many companies. S&P and Fitch use an identical scale, capital letters, whereas the scale adopted by Moody's is slightly different because they use small letters. So if the rating of the bond goes up, let's say it used to be double B, it is now triple B, or it used to be triple B, it is now A, this is considered to be an upgrade. And when an upgrade happens, the bond is now considered to be lower risk. And there will be higher demand for it, so the price will get higher. And when the price goes up, the yield becomes lower. And the opposite is true when the ratings drop. So if a bond was A and was downgraded to BAA or BBB, this is considered to be a downgrade. And when a bond is downgraded, it becomes of higher risk. The price will drop and the yield will go higher. I don't think you will be questioned on these in this exam, but in other exams of CISI, you'll definitely get a question. Continuing with credit rating agencies. Issuers rated AAA by S&P are described as having an extremely high capacity to meet their financial commitments. And Fitch calls them exceptionally strong capacity for payment of financial commitments. In other words, they are likely to be able to pay the bonds, the coupons, and the nominal value. Payment of coupons or interest on loans is what we call servicing the loan. They are highly likely to be able to service the loan. Moody's describes AAA as reflecting issuers of the highest quality with minimal credit risk. Essentially saying the same thing as the two other agencies. As the credit risk of the issuer increases, the assessment of the rating agencies moves down the scale. So when the risk goes up, your rating will drop because you are no longer an A bond, you are now a B bond. This is generally for issuers already in default. Now, with the lowest of Standard & Poor's and Fitch being D. This is generally for issuers that are already in default and failing to pay the bond. The lowest rating from Moody's is C. So, there is an important line dividing these ratings, and this line starts here. So what's considered to be good and safe, and what's considered to be risky? Ratings from BBB and above are what we call investment grade, high quality investment grade strong bonds. Ratings from BBB and below are what we call non-investment grade, or what we sometimes call junk bonds. And also you will find in the exam called high yield bonds. Because these are higher risk, they are going to be yielding a higher profit, a higher return. This line of separation is important. There is an important dividing line between bonds that are rated by the agencies as having less credit risk, and therefore more appropriate for prudent investors, and bonds that are more risky and therefore less appropriate for prudent investors. And this line that separates the lower risk from the higher risk is this line. This is the dividing line between what are termed investment grade bonds and non-investment grade bonds. So this is usually drawn BBB and BAA. So, bonds or equities? Good question. The very basis of most arguments in finance and portfolio management. When a company raises finance, it has two broad choices. To raise money by borrowing, either go to a bank and take a loan or issue bonds, or to raise money by selling more equity, selling shares, selling ownership in your company. To illustrate the impact of choosing one over the other, we will further develop the example of CrazyJet. Now let's assume that CrazyJet at the start of the period is worth $100 million as a company. So the starting value of CrazyJet as a company was $100 million. The company has a profitable year, filling its airplanes with passengers on both its existing routes and a number of new routes. And at the end of the year, it is worth $120 million. This is an increase of 20% over time. Now, if we assume that at the start of the period, CrazyJet was financed only by equity and no borrowing at all, and no additional finance was raised during the period, then all of the 20% gain over the year will be to the shareholders, because this initial starting value of $100 million was purely equity. So when the value of the company went up from 100 to 120, this remains to be purely equity. So this additional 20 million is for shareholders. All of it is for shareholders. However, what if, instead of being 100% financed by equity at the start of the period, CrazyJet had been 50% funded by equity, 50% by debt. So the starting value of 100 million was actually 50 million equity and 50 million debt. Let us assume that the debt has not increased or decreased during the year. At the end of the period, 50 million is still owed by CrazyJet. 50 million is still owed as borrowing at the end of the period. However, all of the 20 million increase in value from 100 to 120, there's a 20 million increase in value, has been earned for the owners of the business, the shareholders. This means that the equity has grown from a starting 50 million to an ending value of 70 million, a 40% increase, and will be preferred by the shareholders to the 20% increase. This is the beneficial impact of leverage. Leverage is the proportion of debt finance compared to equity finance. So in this case, this $20 million extra is for the equity holders. So 20 million $20 or 120, 50 million. Yes. So you started with 50 million, you earned an extra 20 million, and you become, at the end of the period, 70 million. Whereas in the previous example, you start at 100 million, you gain 20 million, and you end the year at 120. Here, you made a 20% return. Here, from 20 million out of 50 million, you've made a 40% return. Leverage is the proportion of debt finance compared to equity finance in the company. It's good to have debt, manageable debt. The impact of leverage is that when a company like CrazyJet performs well, it appears that the larger the proportion of the financing that comes from the debt, the better. The larger the leverage, the more the gain for the investors is magnified. But they have to be careful. However, two particular things have an impact on how much borrowing companies like CrazyJet have. One, how much lenders are willing to lend and how much they charge for that lending, because the more debt you have on your balance sheet, the less likely you are going to be getting any loans. Because whenever somebody lends you money, he's going to see how much equity you have. Do you have enough equity to pay off all of your debt? If your debt is more than the equity, then no, you don't have enough equity to pay your debt in case you go bankrupt. So very few lenders will be willing to lend you money. They should also look at the fact that if the company does not perform well, a larger proportion of the borrowing will have the opposite effect. They will put the company in more trouble. Expanding on the first point, providers of debt finance like banks and bond investors will consider the risk they face when making their loans. Simplistically, the more a company borrows, the greater the risks. As a result, the proportion of debt cannot go beyond the level that presents too large a risk for the lenders to be willing to lend. Also, as the proportion of the debt increases, the credit rating assessment will fall because you are now less likely to service your debt and redeem it. And when the credit risk assessment falls, you get a lower rating. It will make borrowing more expensive. You will have to pay higher interest on your bonds to attract investors. On the second point, if a company performs badly, then the impact of leverage magnifies the loss to the shareholders rather than the gain. Let's consider CrazyJet again. And this time, we presume the value of the business falls over a period. It starts at 100 million, it ends at 90 million. Clearly, if the business were 100% funded by equity, the shareholders would have suffered a 10% fall. If it was completely equity, the shares were worth a combined 100 million, but now they are worth 90 million. So they have lost 10%. What would have happened to the value of their shares if the business had been 50% debt and 50% equity? So in this case, they have lost $10 million. And they have equity of 50 million, so a loss of 10 million out of 50 million, this is considered to be a 20% drop. So if it was completely equity, then they would have lost 10 million out of 100 million, so they would have lost 10%. But because it was combined equity and debt, and they lost 10 million, but the total value of equity is actually 50 million, this shows a loss of 20 million. And that's how leverage either makes profit higher or makes the loss also higher.